So RBI typically comes out with its monetary policy review, during the year, and every 2 months there is a meeting that RBI has where they kind of discuss what their policy stance is, typically trying and playing with interest rates. Now, the monetary policy itself, some of us may know and some of us may not be aware, is the management of money supply within the economy. Typically, your central bank does it. In India's case, RBI being the central bank that takes care of this, and you use the tool of interest rates largely to manage the money supply. You have other tools as well. What kind of tools are available? We do need a little bit of background in this, which we will discuss as we go along. But broadly, the tools of interest rates are moved up or down, and that's how the money supply in the economy is managed by the RBI, right? Now, what is the agenda? We're going to look at the latest policy statement that came out on August 4th. And on account of the bi-monthly policy review, we'll try and understand the rationale for the policy stance. We'll first see what is the policy stance and then try and understand what's the rationale for that. We'll try and look at what data affected their decision making, and in general, making sense of what data RBI looks at in the first place while deciding all the data points and deciding on the rates. And then finally, we'll look at what values various economic indicators in India have, inflation, GDP, etc. Right? A couple of terms that we will find during this particular session and may be relevant for us. We will look at what is called as repo and reverse repo, and we will look at net demand and time liabilities, and we'll look at a liquidity adjustment facility. Just before we go ahead, we will look at what, let's say, the repo is. Now, what is repo? It stands for repurchase agreement. It is the rate at which RBI lends to banks. Why is it called a repurchase agreement? Is because RBI typically is here and the bank is here, and the bank essentially, when it has to borrow money, does not just borrow money, it ends up selling some securities or bonds to the RBI, right? With a promise that they're going to repurchase it. So at the end of this tenure, whatever that tenure is, 7 days, 8 days, 15 days, whatever, at the end, the bank buys back the securities and it returns the money. The money that is returned is essentially the money it borrowed, money plus some interest, and this interest is defined by what is known as the repo rate. So when the RBI raises the repo rate, it essentially makes borrowing difficult for the banks or makes borrowing expensive for the banks, right? It's called a repurchase agreement because of the selling and buying back of the securities that happens, right? Repo rate is the rate at which RBI lends to the banks. Then we have something called as net demand and time liabilities. This is the total liabilities in the banking system. We go and deposit money in the bank. Typically, demand liabilities are liabilities that can be demanded at any point of time. So your current account, for example, is a demand liability. Savings account, whatever portion you can withdraw at any point of time. You can't withdraw everything in all kinds of savings accounts at all point of time, but whatever amount you can withdraw any point of time, that's called your demand liability. Time liabilities, on the other hand, are blocked for a certain time, like fixed deposits, right? So these are time liabilities essentially, and net demand and time liabilities are the total amount of, uh, you know, all kinds of money that has been blocked into the banking system that we have given to the bank so that they could deploy it in terms of usage elsewhere, right? Then we have what is called as liquidity adjustment facility. This is, on a day-to-day basis, RBI manages liquidity in the financial system using LAF. It's called LAF, and this term will also kind of keep coming once again in the policy statement again and again. Essentially, nothing but the entire platform on which the RBI is managing the repo and reverse repo and all the deals that it is doing in terms of injecting liquidity or taking out liquidity in the form of money supply from the financial system is known as liquidity adjustment facility. There are some other terms that will come as we go along, and I'll kind of take them when we kind of continue with the policy statement itself and read that in more detail. So we'll immediately switch to the policy statement. That's the policy statement that RBI released on August 4th, essentially. If you want to look where it can be downloaded in case you don't have a data around it, Reserve Bank of India, the website on Reserve Banks of India in India gives this data. So you can actually go here, and just after they have announced the policy, you'll find this data here somewhere around, right at the bottom, you find third bi-monthly monetary policy statement. You have a lot of other data as well. This third bi-monthly monetary policy statement, when you click on it, you get all the data on August 4 and August 5. This is what we are going to discuss today. The statement of Dr. Raghuram Rajan is what we are discussing. Then there is a press conference, the webcasting, audio recording, transcript, etc. is also available. And then they have a conference call with media and a conference call with researchers and analysts. Transcripts of those are also available. So once you have gone through this particular session, it might be interesting to generally go and try and look at some of these documents as well. They're all available there. If I click on this full document, it will take us to a page where the entire policy statement is available, and you can also download it in the form of an Excel in the PDF file, which is what has been forwarded to you, which is what we're going to look at it now, right? So we are clear with what repo is. We are clear with what reverse repo is, or we have not seen what reverse repo, but LAF is what we have seen. I have a quick question for us before we kind of go ahead. It should appear on your screen now, and you can select one of the answers. If a bank borrows beyond its repo limit, the rate charged by the RBI on this is. About half of us believe it is the bank rate, and the remaining is kind of split between what is the reverse repo and what is the MSF, right? So let's try and understand this data and see whether we are correct or not correct. As we go ahead, let's understand what is reverse repo and MSF. Let's first read the policy statement, what it says. On the basis of an assessment of the current and evolving macroeconomic situation, it has been decided to keep the policy repo rate under the liquidity adjustment facility unchanged at 7.25%. So they have not moved the rate. The rate has been kept constant, right? On the repo, keep the cash reserve ratio of scheduled banks unchanged at 4% of net demand and time liability. What is the CRR, or cash reserve ratio? Banks have to keep 4% of all deposits essentially in the form of cash. This is to safeguard the depositors, that if tomorrow suddenly everyone goes to a bank and asks for money, or someone goes to the bank and asks for money, they do have some amount available there. Which means when we deposit 100 bucks in the bank cannot loan out more than 96. In fact, this number is even lesser. There is something called as statutory liquidity ratio, which is also about 21.5% to be precise. And this is what you have to, again, of all net demand and time liabilities, has to be held in the form of liquid bonds. So effectively, roughly 25% of the deposits can never be loaned out, right? This is to safeguard your money in the bank. So they've kept the cash reserve ratio same as well. They have said that they will continue to provide liquidity under overnight repos at 0.25% of bank-wise NDTL. So every bank can borrow money using overnight repos to the extent of 0.25% of their net demand and time liabilities overnight under the LAF at the LAF repo rate, and liquidity under 14-day term repos as well as longer term repos at 0.75 of the liabilities that they have, net demand and time liabilities, right? So each bank has a limit to which they can go and borrow from the repo market, both overnight as well as for 14-day as well as longer term repos. And depending on their net demand and time liabilities, they have this limit prescribed. So you can't essentially go and borrow beyond this limit without changing the interest rate. So the interest rate that is charged here is the repo rate, right? So that's the repo rate that we see. Now let's go ahead and look at some of the other data, and they will continue with daily variable rate repos and reverse repos to smooth liquidity. Consequently, the reverse repo rate under the LAF will remain unchanged at 6.25% and marginal standing facility rate and the bank rate at 8.25%. What does this mean essentially? This means that, so let's try and understand this now. If the RBI is getting money, which is on repo, and they are getting money at 7.25, the exact opposite transaction is called as reverse repo. Now under reverse repo, banks have excess cash and they deposit the cash with RBI in lieu of securities, which the RBI buys back at a later point of time and pays 6.25%. Obviously, the RBI will pay lesser than what they are earning. So effectively, this 1% is what RBI earns, and that's their earning on a day-to-day basis. Essentially, that comes out, right? So reverse repo is not the rate that is going to be charged on excess limit. Let's understand this limit once again. If a bank has 100, let's say 100,000 crore of deposits, I'm just taking a hypothetical number, then 1% of this is what they can borrow on a day-to-day basis essentially. 0.75% of net demand and time liabilities can come in the form of longer term repos. So that's going to be 750 crore, and 0.25%, that's going to be 250 crore, is in the form of repo. Now that does not mean you cannot go. So this is overnight repo and this is longer term repo, right? Total 1000 crore. That does not mean you cannot go beyond this. You can go beyond this. If you go beyond this, you obviously will be penalized. That penalty has to be at a higher rate. That rate is called the marginal standing facility. So marginal standing facility is 1% higher, which means if you want to borrow more than your repo window or limit, you have to pay marginal standing facility. What is bank rate then? Now, bank rate in a sense is the minimum rate at which banks charge money. But if you think about it, how does the RBI ensure that? Repo and MSF are both for the short term. But if a bank wants to borrow money for a longer term, that's what is the bank rate, right? So essentially, if you want to borrow money for 6 months, 1 year kind of a thing from RBI, that is the bank rate. And because the bank rate is 8.25%, logically the bank cannot lend it out at a lesser value than that. That's how they try to kind of control it, right? So that's the broad spectrum of what data is available. Now let's read a little bit further into this report and understand what they are trying to make sense of and what their assessment is. This is a 5-page report. There's a lot of data that follows. We'll try and look at the data and we'll try and read a little bit about the statements as well, right? So since our last statement, the global liquidity essentially has changed. Global economic activity has recovered in Q2 of calendar 2015. Now remember, Q2 of calendar 2015 is essentially April to June 2015, which for India in terms of fiscal year is Q1, right? US economy rebounded on stronger consumption and steadily improving labor market condition, though recent wage data suggest continuing slack, which means wages have not gone up dramatically, but continues to see stronger consumption. So we see that US is gradually improving, right? Then we see what's happened to Eurozone. That's grown at a moderate pace through the entire first half of 2015, supported by primarily consumer spending, easing financing conditions. Now remember, Eurozone, EU, had also launched what is called as quantitative easing. What is quantitative easing? They printed a lot of money and they started buying a lot of bonds from the market to support financial institutions that were facing trouble. Because of this, a lot of money was flooded in the market. However, there is a modest downturn in the still high unemployment. Unemployment rates continue to remain high in Eurozone. So Eurozone in general is kind of slow. Japan growth slowed in Q2 after a surprise in Q1. In Japan, there is an excessively easy monetary policy running. So they're printing a lot of money, they are letting their currency depreciate, and the government is generally spending a lot of money in terms of trying to create growth, which is resulting in the growth. Domestic consumption continues to be weak. Manufacturing activity is up there. and strengthening exports. This they are doing by virtue of their currency depreciating. So the yen has gone down against the US dollar in this scenario, right? Corporate profitability could stimulate capital spending in the second half of the year in Japan. So Japan seems to be doing fine as well. Gradual improvement in these areas. Emerging market economies, on the other hand, the activity has declined through first half due to headwinds from weak external demand. Primarily, Eurozone has been weak. Tightening external financing conditions, deteriorating structural bottlenecks, essentially local economy conditions have not done well, and spillovers from unsettled conditions in financial markets. Despite aggressive policy stimuli, Chinese economy is slowing on macroeconomic rebalancing. Now, China is a big economy. There is a huge capacity that has been built up in China that's slowing. There are sizable stock market corrections in China. The Chinese stock market index went from 2000 to 5000 in the last 1 year till June, and from June till July mid, it fell from 5000 to 3500. That's a 30% correction, and it's been extremely volatile in the last 2 months. The property market in China is cooling, and there is huge amount of excess capacity in several manufacturing industries. That's an interesting point because this would lead to lower prices, especially in commodities, and that has its implications for India, right? So that creates a little bit of a problem. There is a huge overcapacity in all these industries. Manufacturing activity weakened in July, and near term expectations were kind of clouded. Let's look at what happened in some of the other markets. If you look at Russia and Brazil, essentially both these are sort of commodity exporters, and with global conditions not looking well, commodity prices continue to weaken, right? And geopolitical developments around Russia, etc., caused a shadow on the outlook, including other emerging market economies, right? So that's been a little bit of an issue that played out. In the recent months, financial markets have experienced high turbulence due to the Greek crisis. We know what happened in Greece. Essentially, Greece voted against the reforms that Eurozone has said. So for all practical purposes, there was a Greek default, which the markets actually took okay. Then the Chinese stock market slump caused a lot of movement, about fall of nearly 30% in a month. And then there are kind of sentiments changes, risk on, risk off, which is essentially whether market participants are willing to take their bets or not take their bets based on when the US Federal Reserve will start raising rates, right? This resulted in all sorts of turmoil across markets in the last few months. Bond market sell-off started in Germany. That resulted in bond yields going up. Bond market sell-off will result in bond prices falling. Bond prices are inversely related to yields, so yields started going up. As yields went up, the financing conditions started tightening in emerging market economies. Equity markets did well all this while because people were looking for higher returns with stretched asset valuations until in June, and then sharp stock corrections in China pulled down global share markets as well. We did see a small bit of correction in our markets as well post June, right? So essentially, that's been the denominating movement in the last few months. Currency markets saw an interesting trend. There is a rising US dollar scenario. Now we said that US is gradually improving, so doing well. That results in essentially expectations of a rate hike, interest rate hike in the US. Why? Because the US has had low interest rates for a long while. They have printed a lot of money in the past, and to kind of control inflation from returning when the growth came back, at some point of time, they will have to go ahead and raise rates. When they raise rates in the US, so US interest rate today, let's say, is 2%, India's interest rate is 7%, right? Argument's sake. People will borrow here and people will invest here, right? Thereby making the 5% difference. This hinges on the parameter that currencies don't move. If today US dollar to INR is 60 and this becomes 70, then there is a problem. Imagine $100 converted to 6,000 bucks invested into Indian markets. This gives a 20% return, becomes 7,200. You sell it, and you convert it back to the dollar at 70. You get $103. Now your underlying investment gave 20% return, but your dollar return became only 3%. That's because the currency moved. So this investment hinges on the fact that the currency movement basically plays out correctly. And essentially, because of that currency movement playing out, you will have a possibility of a scenario where if rates go up, then this would become difficult. The margin essentially will become a little bit odd in terms of the, if the margin is 5% today, tomorrow it could become 3%, thereby making it difficult for people to go and invest in, let's say, Indian markets, and thereby leading to some sort of an outflow from India, thereby impacting foreign currency exposures essentially. Now let's say India essentially sees a drawdown in terms of currencies, right? Now what happens because of that? Let's say someone had borrowed $100 million, right? This was at about what, 600 crore. Now if this becomes 70 because of this currency turmoil, when you are repaying back, you have to pay 700 crore. So your principal increases, and this impacted foreign currency borrowing exposures, increased exchange rate volatility, and also produced sizable capital outflows from EMEs because the US dollar appreciated, right? And that creates a challenge. Luckily for us, our currency did not move as much. What impact does that have? We'll look at that. Investors have reduced exposures to emerging market economies as an asset class, but a generalized flight to safety is yet to be seen. If you see this, then you will have a significantly fast drop in financial markets. Investors have also shunned commodities affected by the Chinese slowdown, including bullion, which is gold. So gold prices have gone down. You have also seen significant capital outflows from a lot of commodities, which has resulted in commodities falling dramatically in the past few months, right? Let's look at what has happened in India now. Now, in India, economic recovery is still work in progress. After a strong June in terms of monsoon, July has been below par, but on net, monsoon is near normal. The reservoir levels so far also augur well for the prospects of Kharif output. Thereby, what has happened is particularly for areas that are dependent on irrigation. So consequently, Kharif sowing has been significantly good. It has expanded significantly relative to a year ago. What does that do? If you have extra sowing, that would result in essentially prices under control on the food front. Obviously, once it is harvested and depending on the fact that rainfall continues to be good. These developments, supported by contingency plans for vulnerable districts, provide cushion against adverse weather shocks. If the prospects of a good harvest strengthen, then currently weak rural demand will improve. Now, at this point of time, the rural demand is weak. If monsoons are good, there is a prospect of a good harvest, which would result in rural demand picking up. If rural demand picks up, that could result in a significant uptick in investment activity in the country, because even now about 60-65% of the total population stays in rural India, right? That provides an boost to the activity. Shrinking exports in some industries, in part a result of the weak global demand, as well as in some of those industries where there is a global overcapacity, like steel, right? In these cases, there is an issue, and also in part essentially because INR has been stable against the USD. On the other hand, USD has gone up against all currencies. That means effectively INR has also gone up against all currencies. Now, what does that do? If you're exporting to any other country, then your major trading partner's currency weakening against your rupee will contribute to a weak aggregate demand. Remember, a weaker currency is good for exporters, right? So what has happened is some part of the demand pickup in India that was being seen because of exports has gone down. And while overall, the Reserve Bank survey indicates to flat capacity utilization and new orders. Reserve Bank keeps doing a lot of surveys. Capacity utilization in the industry has stayed flat. There is no uptick there, right? And new orders have also not picked up. Corporate sales growth declining. Corporate sales growth is in value terms. And remember, value will decline because inflation is also declining, right? So if prices of steel fall and you are manufacturing steel, then your sales will appear to be lower even though the output is fine, right? So that's, although lower inflation explains some of the compression in top lines. Think of an oil company, for example. If you're selling petrol and petrol prices have fallen by $10, then obviously your sales will show a lower number, but that's fine. To that extent, it is okay. Overall business confidence is positive. RBI also does surveys in terms of business confidence, and overall that is positive in India. Level of optimism, however, was a shade lower in April to June than in the preceding quarter. So what's happened is Jan to March, the optimism was high, but that's going down now. So while gradual economic recovery continues, there are still a lot of data points that fall in between that we'll have to look at. Let's look at some more data in the same paragraph below. Investment as a measure of new projects is weak, primarily because of still low capacity utilization. That's a very important statement. We see still low capacity utilization. If you actually look at capacity utilization in India at this point of time, this number for approximately, RBI takes a survey of about 1200 companies. This number is close to about 70%. Why is this important? I'll come into a moment and understand that. In the critically important power sector where final demand is strong, India has a lot of power demand but a lack of power supply. Recent step up in generation is response to a commendable easing of bottlenecks in coal supply, which was practically non-existent for about a year in between in India. And partly it has been negated by structural problems related to clogging of transmission grids, which continue to operate on obsolete technology in India and equipment in India, and dire financial state of electricity distributor companies. The discoms are not doing well. So while this is a positive, the transmission network and distribution company scenario continues to be negative for us, right? What does the capacity utilization play out at 70%? We'll come to this in a moment. We'll understand this a little bit more. And this will be one of the important parameters in the RBI policy stance, right? Let's go ahead, look at point number 5. It says there are signs that consumption demand, especially in urban areas, is picking up. Car sales were strong in July, right? So that shows that possibly there is a pickup in the urban demand. That's good for us. Nominal bank credit growth, while lower than previous years, but bank credit growth is essentially the loans that banks have given out. Adjusted for lower inflation, you need lesser loans because the prices of some commodities have fallen, as well as, remember, lower borrowing by oil marketing companies. Your three oil marketing companies, BPCL, HPCL, and IOC, were huge borrowers in the last few years for running their business because they were making losses. This year, because of deregulation of the oil sector, they started making some profits. Plus, oil prices went down, so they did not need as much borrowing. And that resulted in this nominal bank credit growth slowing down because these three companies used to borrow a lot of money, and that is not required now. Adjusted for this, it seems to be adequate for most sectors. So there are signs that urban demand is kind of picking up. How does it continue remains to be seen, but at this point of time, rural demand is slow. If rainfall is good, that is expected to pick up. Urban demand is kind of showing initial signs of picking up. Let's go further, look at what's the services sector scenario. Point number 6 talks about services sector continues to emit mixed signals. Pickup in commercial vehicle sales and rising port and domestic air freight in Q1, which is fiscal year Q1, April to June, shows strengthening transportation activity, right? So that is good because obviously businesses are using these services. There's an index called Purchasing Managers Index, which is essentially sort of a business confidence index that is in contraction zone, and mainly due to the weak new and existing business conditions. Survey-based expectations show positive scenario in the services sector on the back of an expected increase in turnover and profit margin. So if you generally go and take a survey of a services segment company, that's fine. Purchasing managers indices, which is a sort of a business confidence indicator, is in contraction zone. Transportation activity has picked up a little bit, right? So that looks to be good at this point of time, right? Then we go ahead and we look at what headline consumer price inflation data in terms of inflation. What does that signify? Now that rose for the second consecutive month in June to a 9-month high on the back of broad-based increase in upside pressures. And this was against consensus expectations. The expectation was that inflation would slow down. That hadn't, especially on the CPI front. Remember, CPI is consumer price index. We also have something called as WPI, which is wholesale price index. That's actually negative at this point of time in India. The When I say index is negative, index growth is negative, which means inflation is negative on the wholesale price index. But CPI is at a 9-month high now. And that's on account of a few things. The sharp month-on-month increase in food and non-food items, right? So food inflation rose 60 basis points in the over the preceding month, driven by a spike in prices of vegetables, protein, especially pulses, meat and milk and spices that has picked up the food inflation. Because of the food inflation increasing, excluding food and fuel inflation as well, inflation rose in respect to most groups other than housing. Housing prices did not pick up significantly, but everything else kind of went up. That's also because fuel prices kind of went up in this period as well. You look at some of the other items like personal care and effects and other goods and services subgroups that also kind of went up a little bit, right? You also have this measure called inflation in CPI, excluding food, fuel, petrol, and diesel, right? This term, excluding food, fuel, petrol, and diesel, is what is known as core inflation. Why are you removing food, fuel, petrol, and diesel? Is because these four items essentially are supply led. The price of food does not go up because demand for food has suddenly gone up. It usually goes up because supply has gone down. And in such a scenario, you can't change interest rates to stimulate demand there, right? So if onion prices are going up, raising rates is not going to result in demand slowing down, right? So you remove this and then you try and look at this. And that has also been rising steadily since April. So that's a worrisome sign that inflation has started going up, which is why RBI did not move the policy rate at this point of time. They had cut rates in June, but they are now trying to kind of wait for a while, right? And exceeded headline inflation. Headline is the total CPI number that we saw. CPI minus food, fuel, petrol, and diesel is what is core inflation. Core was bigger than CPI for a few of the last few of the months. And that's because the other items in general were kind of negative for a lot of times, right? Now, the RBI also takes inflation expectations of households. That was going down, while in general, if you go and ask a general layman on the street, the inflation expectation is going to be higher than what the actual inflation is. This is at double digits. The actual observation is around 6-7% or so, but this went below double digits in the last 2 quarters. Before that, it has again now come up to double digits, although those expectations of professional forecasters remained anchored. So essentially your economists have not yet moved their estimates of what is going to be inflation. They continue to kind of maintain the inflation estimates, right? Next, we move and look at a little bit more complicated paragraph which says liquidity conditions have been very easy in June and July. What does this mean? There has been excess money supply, right? Excess money supply. How do we know that? So there is a general reduction, seasonal reduction in demand for currency around this time. The government has spent a lot of money with some structural factors also coupling it. Government spending money will result in money flowing into the markets eventually. And you have low credit deployment relative to the volume of mobilization, right? So deposit mobilization has been significant, but credit deployment has been low. So credit offtake has not been high. So there is a surplus condition in money markets. How do we know this? If you look at what has happened in the LAF and MSF, in June, in May, you had a transaction of about rupees 1031 billion, but that number became about 477 billion in June, right? Now, in response to the reduction in policy rate, the weighted average call rate, what is call rate? This is the overnight lending rate between banks, overnight lending rate, interbank. Essentially, that's like the call rate. The call rate actually eased from 7.47 to 7.11, right? Which basically means that money is available at 7.11 in that market, thereby resulting in banks actually not going to the RBI for enough repo transactions, right? So for all practical purposes, liquidity conditions were fairly easy in these 2 months, right? Interest rates had also kind of been lower in the market than what the repo indicated. Again, actually telling us that there was no real reason for a rate cut at this point of time, right? Then they also say RBI conducted open market sales worth rupees 83 billion in the second week of July, essentially in response to lack of demand for longer duration reverse repos. In reverse repos, the RBI would sell bonds and get some excess money. There was no requirement for that essentially, and there was no demand for that. So RBI went and did open market sales worth of a few bonds, right? Now let's try and look at one more question around this time. If the central bank decides to sell more bonds than what was expected in the open markets, this would result in the interest rates. What will happen to the interest rates? Will they go up? Will they go down? Or will they stay the same? Will this change the interest rates at all? Go up, go down, or remain the same if they sell more bonds in the markets? Let's look at the results. So we see that roughly 66% of us believe that it's going to go down, and another 30 or 1/3 of us believe that it's going to go up, right? Let's understand. If the RBI sells bonds, what happens? You sell bonds, that increases bond supply, that should result in bond prices falling, right? And that should result in essentially interest rates going up, correct? Also, if you sell bonds, you take out liquidity, which means there is less money, and that makes money costlier, right? Money supply will go down, so money should become costlier. So on the contrary to general majority belief, interest rates should actually go up, not go down in the scenario. Logically also, if you think about it, the RBI would not want the interest rates too far away from what the policy rate is. So if it has fallen too much, they would want to suck out that excess liquidity from the market, trying to keep it close to where they want interest rates to be, right? So essentially there was enough and more liquidity in the markets that resulted in this scenario playing out. Now, then let's look at what's happened in terms of the exports and imports scenario in India. That's point number 10. Before we go there, another quick question for us. India's trade deficit has gone down. That's data that we're going to see in some time. Why has that gone down? Is that because imports have gone down? Is that because exports have gone up? Or is that a combination of both of these? So about 45% of us believe both have happened. 39% believe shrinking imports. 16% believe exports have increased, imports have not shrunk. Let's look at the answer. Let's look at what's happened. That's available in point number 10. Headwinds from weak global demand conditions restrained merchandise exports. The contraction in exports in Q1 of 2015-16, both volume and value, was the steepest since 2009-10. Now that's not good news. All this while we were saying make in India and exports should increase, but exports have actually gone down, right? That's why has that happened? Sharp fall in international commodity prices, especially crude oil, compressed import payments as well. So imports also went down, but imports went down more than what exports went down. That's because crude prices fell sharply, and that resulted in narrowing the trade deficit. So the answer here is not both increasing exports and decreasing imports. In fact, both have decreased, just that imports have shrunk more than export shrinking, right? Domestic production shortages and lower international prices were evident in higher import of electronic goods, pulses, iron ore, and fertilizers. However, you have had surpluses on account of trade in services. So services, we export more. So services export is net in India. That's a net exporters of that. That reduced the current account deficit. And even though portfolio flows, which is foreign institutional investors, FII, or what is also called as FPI, foreign portfolio investment, have slowed down. Other forms of foreign capital such as FDI, foreign direct investment, and non-resident deposits were sustained. So FDI plus NRI deposits or remittances were good, and that resulted in dollar inflow. Exports in services resulted in dollar inflow. Imports falling more than exports in goods and merchandise resulted in saving of a few dollars. That resulted in forex reserves building up to an all-time high at the end of June. We almost have now USD 360 billion worth of forex reserves, and that's purely because of a combination of all these things playing out, right? Now let's come to the policy stance and rationale, and that's the important part in terms of putting all this data together. Now they are saying that a few things have not happened. They are going to maintain the accommodative stance of monetary policy. What does that mean? That interest rates will not go up. That is for sure. They may cut it immediately, they may cut it at a later point of time, but they're surely not going up. That's a clear stance that they have communicated. What they want is fuller transmission by banks of RBI's front-loaded rate reduction. So RBI is saying that we were actually supposed to cut it in, let's say, October, November, December. We have already cut 75 basis points in calendar year 2015. Right? Now it's up to the banks to pass that on. We'll look at what amount has been passed on. That's one. Then the second, development in food prices is what they have to monitor and their management, especially the effects of monsoon, while looking through both seasonal as well as base effects. Right? I'll explain base effects in a moment. The third one is acceleration of policy efforts to unclog the supply side so as to make key inputs such as power and land, etc. available. Now this is under the purview of the government. So they want the government to act, and if these are unclogged, then essentially you start making some sort of a movement in terms of more logical use of the money, as well as more money supply increasing on the fiscal side. Also repurposing of public spending from poorly targeted subsidies towards public investment and reducing the pipeline of stalled investment. So they've given three targets to the government. Acceleration of policy efforts to unclog the supply side, that's one. Then you have said repurposing of public spending from subsidies to proper public investment, and three is reducing the pipeline of stalled investment. So these are the 3 points that they have put for the government, that you need to act on this as well. And then they are saying signs of normalization of the US monetary policy. Now they will know when the US will start increasing rates, and based on that rate discussion, it's expected that in September US is going to start increasing rates. What happens to currencies because of that, what happens to global markets because of that, will also be a data point in their thought process, right? So that's one point that also came out of what data they looked at. Let's look at what is the other data that they have seen. They are saying that since the first rate cut in January, the median base lending rates of banks have fallen by 30 basis points, which is a fraction of 75 basis points so far. So practically the first point that they made is banks have not transmitted this. That's a problem. So RBI is cutting rates, but banks have not cut down the rate. So unless that happens, RBI says there's no point in us cutting rates only, unless banks cut that as well. Then they kind of talk about government infusing more capital into public sector, which will give them more money, and that more money will result in lower interest rates and more money to lend out. So hopefully banks should be able to transmit this. Then they have said in 2015-16 so far, inflation conditions have evolved around the path projected in last year policy statements, right? In the policy statements in April and June, they talk about what is called as large base effects, which the RBI will look through. So they will ignore this, are expected to pull down headline inflation in July and August. So what happens because of base effect? Let's say in 2013, July, the inflation index was at 100. In 2014 July, the inflation index is at 110, and in 2015 July, the inflation index is at 114. Now, because you saw a big jump of 10% here, you will see probably a small jump of 3.5% here. But over a 2-year period, your inflation has averaged around 6.5 to 7%. Correct? So this is what high base effect is. Large base effect will show you mathematically that headline inflation numbers are lower in July and August, post which this high inflation number will wane down, and then automatically you will revert back to historical conditions. So they're already saying that the readings you see in July and August, and the July reading should be out in the next few days, you will see these readings to be lower than what is expected, and that's because of last year high base numbers, right? So they will see through that. They know what the reason is, and hence they don't care about that too much. So that's your base effect discussion. Let's move ahead and discuss about balance of inflation risk. What they're saying is most worrisome is the trend of hardening of inflation excluding food and fuel. What has also happened is full effects of service tax increase is also going to feed through. Service tax was increased from 12.36 to 14% during this period, and that will feed through the rest of the year. Some food items, protein rich items like pulses and oil seeds, they have risen sharply, and these have to be carefully monitored as they tend to be sticky. Once the price goes up, it stays there, and this imparts an upward bias to inflation and inflation expectations. Significance, in the view of household inflation rising again. However, there are several mitigating effects as well. There is a sharp fall in crude prices since June. So prices of crude were around $60 and they've gone back to around $45. That's not incorporated in this. Likelihood of this softness persisting in view of global supply glut. There is a huge global oversupply. And to add to that, there is an additional production from Iran. Remember, in the last month, there was this nuclear deal that was signed with Iran. So Iran had sanctions lifted. So global sanctions that were lifted on buying crude from Iran were lifted. That results in more crude coming up from Iran. That increases the global supply, and that should keep the prices of crude under pressure. So that's a welcome scenario. And then they say welcome increase in planting of pulses and oil seeds and prospects of rainfall in August and September, according to some forecasters. Now, already some forecasters are saying normal monsoon, although the Indian Meteorological Department does not agree to it as yet, right? The effect of government's current proactive supply management. It seems the government is also trying to contain shocks to food prices by managing supply, especially of vegetables, etc. All these put together are positives on the inflation scenario. Crude price significantly lower, a normal or better than expected monsoon scenario, that should do well to kind of keep inflation under control. If that continues to be the case, we should see lower rate cuts. And then they come up with a projection of what is expected to be the CPI inflation. So their target inflation is around 6%, right? And then they give what is known as confidence interval. They have a 90% confidence interval that inflation will be between 9.5% approximately on the upside and 2.5% approximately on the downside. With a 50% confidence interval, they say that it will be somewhere between 5% and 7% for the entire year. It's a difficult task to forecast inflation. They do say that expectations in general have kind of moved lower as a trend, but it stays here and this probably increases a little bit depending on what happens with monsoon, etc. that is going to follow in the near term, right? What do they talk about growth? They also talk a little bit about growth. They're saying that taking into account all this, and given that policy action was front loaded in June, which means they did not want to do it there, but they did it nevertheless, saying that we'll not do it later. It is prudent to keep policy rate unchanged at the current juncture while maintaining the accommodative stance, which means directionally they are going to cut rates, but they might want to wait for a while in between. Then they talk about short-term rates. Real risk-free rates are nonetheless supportive of borrowing by interest rate sensitive segments. Significant uncertainty will be resolved in coming months, including the likely persistence of inflationary pressures, whether that will happen, full monsoon outturn, whether that will happen, as well as possible Federal Reserve actions, whether they will increase rates. as they await greater transmission of its front-loaded past action. That's like nudging the banks to say, please pass it on. We will monitor developments for emerging room for more accommodation, which means more rate cuts. So in a sense, they have done two things. They have said to the banks, please pass on the rate cuts, and they have told the government, please get your house in order. And now they are waiting for the rest of data in terms of monsoon, and they are waiting on data in terms of the US Fed. And once this set of data comes in, they will kind of take a decision in the next policy meet probably, or the one after that. The outlook for growth is improving gradually. Favorable income projections, because of weaker commodity prices, in particular crude oil, etc., would, and a possible step up in agricultural activity if monsoon conditions continue to improve. This should result in favorable real income effects. On the other hand, global projections have been revised downwards, and therefore export contraction could become a prolonged drag on growth going forward. That's a little bit of an issue. Notwithstanding some improvement in the state of current projects, stalled projects, supply constraints continue to be binding, and new investment demand emanating from private sector and central government remains subdued. On an assessment of the evolving balance of risk, projected growth has been retained at 7.6%. They have also kind of given a trajectory for growth, similar confidence interval scenario. There's a 50% chance that growth will be somewhere between close to about 7% and between 8.2, 8.3, 8.5% odd. That's the trajectory, whereas the middle point, the mean estimate is around 7.6%. They have retained it there, which is reasonably good growth as we look at it. And then they kind of say that the fourth bi-monthly statement will be announced on September 29. That's where this particular section ends. So let's summarize what they have said so far. They are saying that there is a gradual recovery of growth. Then they're saying supply constraints remain, where the primary responsibility is for the government to bottleneck those. RBI will continue with the accommodative policy. Rates should not rise for sure. Inflation should likely come down, both aided by lower crude prices and by higher plantations or planting around the normal monsoon. Rural demand may pick up post-monsoon, which is a good point. Enough liquidity into the system for now, and banks need to transmit rate cuts. So now look at things here. Enough liquidity, banks need to transmit rate cuts, and you have low capacity utilization. And plus, the government needs to take a lot of actions. If you think about it, people say that RBI should have cut rates. The media actually makes us believe that RBI should have cut rates. The time was ripe for a rate cut. If you cut rate and a business is operating at something like a 70% capacity utilization, do you expect them to borrow more money and put another factory or another set of capacity? On the margin, yes, if I was already planning to borrow money, that makes life easier for me. But if I already am sitting on 70% capacity utilization, it is very unlikely that rate cuts will have any impact unless other bottlenecks are solved. Structural bottlenecks in the economy are solved, right? Moreover, rate cuts will only increase liquidity, and there is more than enough liquidity in the system already, right? Third, they have cut rates, but banks have not transmitted it. So what's the point of RBI cutting rates if the banks are not going to let it go through into the system? And fourth, they want the government to act first. If they force the government to act on the fiscal front, logically that would be a much bigger structural reform than just trying to say that RBI should cut rates. So RBI would probably be all for rate cuts, as is evident in this particular point, that they want to continue with the accommodative policy. But remember, the first principle of a monetary policy is essentially that you have to control inflation. That's your first task. The second task is that you want growth at a reasonable price. Growth can always be also controlled using fiscal policy. The government can inject growth into the system. The RBI's philosophy or the idea is therefore to continue to look at inflation as the primary point. And that's why they are ensuring that they don't cut rates too soon, because that might result in a little bit of inflation flowing into the system, right? So that's where broadly we come to an end of this particular section. In terms of our discussion, we would be open for queries now, but that's where this particular session ends.